If you think Benjamin Graham's investment teachings are outdated, you might want to think again. With the rise of cryptocurrencies, startups, and exponentially growing tech companies, many people believe that the old rules of investing no longer apply. But is that really true? Would Graham, Warren Buffett's mentor, completely ignore this new landscape? Or would he simply adapt his principles? Stay until the end, because today you will discover how to apply the rules of the intelligent investor in the digital age, and more importantly, how to avoid the mistakes that cause thousands of investors to lose money every day. Most people entering the market today are looking for quick returns. The problem is that this mindset makes many ignore fundamental principles, bet on fleeting trends, and end up losing everything. How many investors got caught up in the Terra Luna hype and saw their investments evaporate overnight? How many put all their money into revolutionary startups like WeWork, only to watch their empire collapse? This is exactly the kind of mistake the intelligent investor was created to avoid. But how do we apply these principles in today's market? To answer that question, we need to go back to basics and understand the three pillars of intelligent investing: the margin of safety, the concept of Mr. Market, and fundamental analysis. Let's start with the margin of safety. This principle states that you should buy assets at a price well below their true value, creating protection against miscalculations or sudden market shifts. Now think about how to apply this to the world of cryptocurrencies. How can you tell if a token has real intrinsic value or if it's just inflated by pure speculation? The answer lies in the asset's real utility, technology adoption, and project development. If an asset relies solely on new investors to keep rising, that's a red flag that it could be a bubble about to burst. The second pillar is the famous concept of Mr. Market. Graham describes the market as an irrational investor, one day extremely optimistic, the next completely desperate. In the digital world, this is more visible than ever. How many times have you seen Bitcoin drop 20% in a single day, only to recover everything the following week? The intelligent investor knows that volatility is not the same as risk, it's an opportunity. Instead of panicking over dips, they use them to buy quality assets at low prices. If Graham were alive today, he probably wouldn't be on Twitter tracking every market fluctuation. He would be analyzing which assets are truly worth holding for the long term. And that brings us to the third pillar: fundamental analysis. In the traditional market, this means examining financial statements, revenues, profits, and company debt before investing. But what about in the digital world? How do you analyze a cryptocurrency or a tech startup? The secret is to look at the development team, the business model, the project's utility, and its market adoption. If a crypto asset or company lacks a solid foundation, its value is likely based on pure speculation and could collapse at any moment. This explains why some cryptocurrencies have disappeared, while others, like Ethereum, continue to grow year after year. Now that we understand the basic principles, the big question is, would Benjamin Graham invest in Bitcoin? This is a topic of debate, but one thing is certain: he wouldn't invest blindly. He would analyze the asset as a whole, evaluating its security, market adoption, and true intrinsic value. Graham would probably see Bitcoin more as digital gold than as a traditional stock, meaning he might use it as an inflation hedge but not as a primary investment. On the other hand, he would analyze tech companies the same way he analyzed traditional companies, looking for those with sustainable growth, strong financial fundamentals, and a solid business model. He would likely be interested in giants like Apple, Amazon, and Google, but would avoid overvalued, unprofitable stocks, even if they were trendy. Another big mistake modern investors make is herd mentality. What happens when everyone starts talking about a new cryptocurrency or revolutionary stock? The price skyrockets, but often for no real reason. In 2021, we saw a strange phenomenon. Millions of people buying Dogecoin just because it was a meme, with no real analysis behind it. The same happened with GameStop, AMC, and other meme stocks. Graham always warned against this type of behavior. The intelligent investor doesn't follow the crowd. He analyzes the market rationally and only enters when there's a margin of safety. In the digital world, this means avoiding assets just because everyone is talking about them. The key is to seek real value before investing. If there's one thing Graham advocated for, it was patience. He knew that building wealth through investments doesn't happen overnight. The problem is that in the digital market, everything moves fast. People want to multiply their money in weeks, not years. But the world's greatest investors follow a completely different strategy. If we look at Warren Buffett, for example, he bought Coca-Cola stock in the 1980s and still holds it today. The same applies to tech companies that have proven their long-term value. The challenge for modern investors is resisting the temptation of quick gains and focusing on sustainable growth. The big question is, how do you know if an asset truly has value? In the traditional world, Graham recommended looking at financial statements, profits, and business models. In the digital world, the analysis changes slightly, but the principles remain the same. If we're analyzing a cryptocurrency, we need to ask, does it solve a real problem? Is the team behind the project solid? Are major companies or governments interested in this technology? If the answer is no, the asset might just be speculation. In the case of tech stocks, the best approach is to examine a company's earnings, its ability to innovate, and its sustainable growth. Many people say that value investing is dead, but that couldn't be further from the truth. In fact, Graham's principles are becoming even more important, especially since the digital market is full of traps. The key for the modern investor isn't to avoid new technologies, but to know how to separate hype from real value. Companies like Amazon, Google, and Microsoft have proven that technology can be a solid investment when analyzed correctly. The great lesson is that Graham's principles are timeless. What changes is how we apply them. If there's one thing we've learned from this video, it's that the intelligent investor is not outdated. On the contrary, in the digital world where the risk of bubbles and speculation is higher than ever, Graham's principles are an essential defense. So now I want to hear from you. Do you think Graham would invest in Bitcoin? Which tech companies do you believe follow the principles of value investing? Leave a comment below so we can discuss. And if this video made sense to you, don't forget to like and subscribe to the channel for more content on intelligent investing. See you in the next video.